Okay, so aside from different reporting entities being included for financial statement purposes and for tax purposes, there are other reasons. Um, this is a good figure, by the way, that kind of gives a picture of um, how all the general ledger information for a company produces a trial balance, but then you end up with adjustments according to all the GAAP rules. These are the rules that determine what your financial statement income will be, and the different kinds of adjustments that are necessary in determining what your corporate tax return will show as far as income goes. And we'll talk about this schedule right here on the tax return. It explains or reconciles the differences between the two. But anyway, back to the discussion though. There are different taxes that are that are part of the financial statements as compared to the tax return, the federal tax return itself. And the financial statements, you're talking about federal, state, local, and all foreign income taxes that apply to the company or that are applicable to the company. All of those are wrapped up and reported in the financial statement income tax expense number. On a tax return, especially on a federal tax return, you're just talking about U.S. federal income tax. So comparing apples to oranges when you're looking at income statement income tax number versus a tax return tax liability. And then finally, the different methods of accounting exist between book and tax purposes. For book purposes, generally accepted accounting principles are the rules that govern what's included in net income. And as we saw in Chapter 2, the Internal Revenue Code is responsible for determining what's taxable on a tax return. And there's lots of different differences, specific types of differences that we'll look at between the two also. Some of the differences are temporary and some are permanent. Examples of permanent differences are discussed right here. These are things that are going to, no, sorry, these are temporary first. We'll get to permanent in a second. Temporary differences are things that are going to be recorded on both the income statement and on the tax return, just in a different period. And here's a discussion of several of those items. Um, and I'll go back up to the schedule in a second. Examples of permanent differences are right here. A permanent difference is something where the item is going to show up on an income statement as an expense or income item, but it's never going to show up on the tax return. Or vice versa, it'll show up on the tax return as a taxable item or a deductible item, but it'll never show up in the income statement. All right, here's a few examples there. This Schedule M1 that I referred to earlier, this is the schedule on a tax return, a federal Form 1120, the tax return that corporations file, that reconciles income per books or financial statement income right here to taxable income right here. So all of the items that increase taxable income, either income items that weren't in the books or expenses on the books that aren't deductible, go on this side, so it adds going down. And items on this side are reductions in taxable income. So this is income that was on the books but it's not taxable. It gets subtracted out. And then here's deductions on the tax return that weren't expenses on the books. And they get subtracted out too. So this is a good spot for auditors to start because they trust book income because it's been audited. All of these differences, though, are usually where tax planning is shown to IRS agents. If you see big subtractions down over here, then you know the company is doing some planning to reduce taxable income. This is a good concept summary to realize. This kind of gives you a picture of all the stuff I just talked about in these first two videos dealing with differences between book income and taxable income. All right, I'll start learning Objective 2 in the next video.